Think about how you get from point A to point B today. You tap a button on your phone, a vehicle shows up, and you're routed to your destination.
Right, it's seamless.
Completely seamless.
Mm.
But I want you to project that forward, say 5 years. Is there even a human behind the wheel?
Or are you bypassing ground traffic entirely in an electric air taxi?
Exactly. The infrastructure of global movement is undergoing this massive structural shift right now. And there is one specific entity sitting right at the center of that transition. Welcome to today's deep dive.
Thanks for having me.
We've built this customized exploration specifically for you, the listener, diving into the mechanics of a company that has fundamentally altered urban mobility.
It's a pleasure to be here, and I have to say, we are looking at a particularly complex stack of sources today.
Oh, we really are.
All right,
I mean,
sir.
the material spans Q4 2025 earnings reports, Wall Street analyst forecasts, technical charts.
A highly consequential UK Supreme Court ruling.
Yeah, and even some really rigorous due diligence from the Reddit value investing community. Our mission for this deep dive is to synthesize all of this data to answer one burning question. Is Uber stock, which is trading around $73.84 as of today, March 9, 2026, a good investment?
And as you can see from the dynamically changing backdrop behind me, which currently looks like a bustling, futuristic cityscape.
It looks awesome, by the way. Very cyberpunk.
Thank you. It illustrates that Uber is standing at a fascinating crossroads right now. To really evaluate the stock properly, we need to look past the top-line numbers. We are digging into the hidden mechanics of their cash flow, the geopolitical and regulatory landscape, and of course, the looming autonomous vehicle revolution.
Okay, let's unpack this. We have to start with the sheer volume of that Q4 2025 earnings report. The network scale is just hitting unprecedented levels.
40 million trips a day.
Yeah, 40 million trips daily, and they crossed 200 million monthly active users. Plus a 22.5% year-over-year growth in gross bookings, hitting $54.1 billion for the quarter.
Those metrics represent a density that creates virtually insurmountable network effects for any regional competitors. I mean, when a routing platform reaches 40 million daily transactions, the algorithmic efficiency and the dispatch routing create a barrier to entry that is just incredibly capital-intensive to challenge.
But the more telling signal to me was the capital allocation strategy. Management announced a $20 billion share buyback program.
Which is huge.
It is. That's roughly 10.7% of Uber's entire market cap being retired. For a company that spent its first decade, aggressively burning venture capital to subsidize rides and capture market share, pivoting to a $20 billion buyback, indicates they believe their highest return on invested capital is now their own equity.
It completely shifts the investment thesis from a high-growth cash incinerator to a mature cash compounder. And to understand how they actually funded that transition, we have to evaluate the super app moat.
Right, because unlike competitors,
Take Lyft, for example. Lyft holds roughly a 32% U.S. market share, but their operational model is almost entirely restricted to pure rideshare. Uber controls 68% of the U.S. market because they established cross-vertical integration. They bundled mobility, grocery delivery, restaurant delivery, and freight into a single ecosystem.
which fundamentally lowers customer acquisition costs across all the verticals. You acquire a user for mobility and then cross-sell them high-frequency, lower-margin food delivery to lock them into the app ecosystem.
Precisely. But that super app architecture also facilitates high-margin secondary revenue streams. The real standout from the Q4 sources is their ads business, which just surpassed a $1.5 billion annual revenue run rate.
A $1.5 billion run rate on ads changes the valuation narrative entirely. We're no longer just evaluating a logistics and routing network. We have to start pricing in digital advertising multiples. Advertisers are paying a premium because the user intent is inherently transactional. You don't open Uber Eats to browse.
Right, you open it to spend money, and that high-margin ad revenue is a primary catalyst for institutional accumulation. We're seeing funds like Bill Ackman's Pershing Square taking massive positions.
Yeah, Ackman holds over 30 million shares valued at approximately $2.47 billion. That represents nearly 16% of his total portfolio. When a traditional value-oriented activist investor allocates that heavily into a former growth-at-all-costs tech stock, it signals a really strong conviction in the underlying unit economics.
And their free cash flow generation.
And this is but before we price this entirely like a high-margin ad network, let's look at the friction in the current trading data. The skeptics are bringing receipts, and the technical setup is remarkably divergent from this blowout fundamental narrative. According to the technical analysis from Chartmill, Uber's rating is currently sitting at a 0 out of 10.
A flat 0 on the technicals indicates a severe momentum breakdown, regardless of the Q4 earnings beat.
Exactly. Both the short-term and long-term moving averages are flashing bearish signals. The stock's been trapped in this wide, volatile trading channel between $69 and $78 over the last month.
And it's underperforming the broader S&P 500.
Which brings us to a fascinating piece of due diligence from the Reddit value investing community regarding Uber's reported $9.8 billion in free cash flow for 2025. They are aggressively challenging the quality of those earnings.
What's fascinating here is the mechanics of what retail analysts have dubbed the insurance trap. They isolated a critical line item in the cash flow statement adjustments. When you evaluate that $9.8 billion free cash flow figure, you have to back out the working capital adjustments.
And when you do that, you find that roughly $2.66 billion of that reported cash is generated by an increase in accrued insurance reserves.
Right, which significantly distorts the operating cash flow. Uber is retaining cash for incurred but not yet reported claims. Under standard accounting principles, that float sits on the cash flow statement as an inflow today, but it is a definitive future liability that will eventually be paid out.
So it's cash on hand, but it is not discretionary cash flow that can be used for buybacks or M&A.
It acts as an operational float, very similar to a traditional insurance company. When the Reddit analysts normalize the cash flow by stripping out that $2.66 billion insurance reserve build, the adjusted, quote-unquote, real free cash flow drops to around $7.1 billion.
Which is still a robust figure, but it completely alters the valuation framework. You're jumping from roughly a 15x multiple on reported free cash flow to over 21x on the adjusted metric.
And that multiple expansion is exactly why the technicals might be lagging the fundamental headlines. Institutional algorithms are pricing in the adjusted cash flow, not the JAP reported number.
But to maintain analytical parity, we also have to factor in the balance sheet anomalies working in their favor. Uber has accumulated over $30 billion in net operating losses from their early expansion phase.
Yes, the NOLs. That $30 billion NOL acts as a massive structural tax shield. It provides a multi-year runway where Uber can generate billions in pre-tax income while deferring corporate tax liabilities almost entirely.
So while the operating cash flow multiple might be stretched by the insurance float, the net income conversion is heavily protected by this historical asset.
But a tax shield is only valuable if you consistently generate taxable income. If their margins contract, that multi-year runway stretches out indefinitely, which erodes the time value of those NOLs.
And that risk leads us directly to the external forces. How are governments and regulators impacting Uber's bottom line today? Because looking at the somewhat disappointing Q1 2026 guidance, management guided for non-JAP EPS between 65 and 72 cents, falling short of the 73-cent consensus.
That guidance miss is really the anchor of the bear thesis right now. It is primarily driven by escalating regulatory headwinds, specifically the recent tax law alterations and the reclassification of driver payments in the UK.
And from what the analysts are saying, this regulatory shift is projected to compress Uber's mobility revenue margins by a whopping 350 basis points.
Right. A 350 basis point margin compression in a volume-driven logistics model is severe.
It directly attacks the operating leverage that the entire bullish thesis relies on.
If we connect this to the bigger picture, the UK margin hit is a direct downstream consequence of the landmark UK Supreme Court case, Uber BV v. Aslam. This ruling established a legal precedent that regulators globally are analyzing to restructure gig economy labor classifications.
And we should look objectively at the mechanics the court evaluated here. We're just reporting the facts of the case and the financial impact on margins, remaining completely impartial on the labor politics. The ruling didn't center on the concept of driving a car. It centered on structural subordination.
Exactly. The court isolated three specific mechanisms Uber utilized to control the driver pool. First, the algorithmic rating system, which Uber deployed as an internal performance management tool to terminate drivers falling below baseline metrics.
Second, the intentional restriction of communication, preventing drivers and passengers from establishing independent commercial relationships outside the Uber ecosystem.
And third, the complete centralization of pricing. Drivers lack the autonomy to set their own fares or negotiate rates, which is a fundamental tenet of independent contracting.
The court determined that this triad of controls created a rigid, asymmetrical dynamic, precluding drivers from operating as genuine independent entrepreneurs.
And the financial consequence of that reclassification is exactly what we are seeing modeled into the Q1 2026 guidance miss. The regulatory environment is shifting away from the binary contractor versus employee debate and settling into hybrid models that mandate minimum pay guarantees and benefit accruals.
It structurally raises the floor on their cost of revenue.
It does, and it forces investors to question the long-term scalability of a human-dependent logistics network if labor costs are continually forced upward by global legislative bodies.
Here's where it gets really interesting, though. We are pricing in human labor costs, but the underlying narrative of the transportation sector is shifting away from human drivers entirely. We have to evaluate the existential threat or potential catalyst of autonomous vehicles.
The AV revolution.
Yeah, Waymo is rapidly expanding its operational footprint, and Tesla's Cybercab platform is dominating headlines. Is a vertically integrated robotaxi fleet going to commoditize Uber's routing network?
Notice how the visual behind me has shifted to a synchronized automated traffic grid. This represents the data from Uber's Q4 2025 AV Spotlight presentation. The prevailing market anxiety assumes AV deployment is a zero-sum equation.
That a user taking a Waymo inherently destroys an Uber transaction.
Exactly. However, the current penetration data suggests otherwise. As of this quarter, autonomous vehicles account for merely 0.1% of global rideshare trips.
At 0.1% penetration, the total addressable market is functionally uncaptured.
It is. Uber's strategic presentation systematically deconstructs the assumption of rapid AV dominance by highlighting what they term the San Francisco illusion.
Oh, I love this concept.
It's crucial. San Francisco operates as the primary AV incubator because it possesses a highly specific, anomalous environment. It's a dense, tech-literate demographic mapped onto a compact grid with predictably mild weather patterns.
But the sources reveal a critical geographical breakdown of Uber's revenue distribution. Trips originating within Uber's top 20 cities globally only account for 30% of their U.S. gross bookings and just 25% of their profits.
That means 75% of Uber's U.S. profit pool is generated in the long tail. We're talking sprawling suburban networks, mid-sized municipalities, and rural routes where unpredictable weather and complex edge cases make profitable AV mapping extraordinarily difficult.
That geographical dispersion is the core of Uber's defensive moat against pure-play AV operators. A vertically integrated AV company operating a fixed fleet struggles with capital efficiency outside of dense urban cores.
This is exactly why Uber is aggressively positioning its hybrid network architecture. The structural flaw of a pure robotaxi fleet is demand volatility. The data shows that in a market like Austin, mobility demand on a standard Monday is only 45% of peak Saturday night volume.
So if a competitor capitalizes an AV fleet scaled to capture the Saturday night peak, 55% of those multi-million-dollar autonomous assets are sitting idle on Monday morning, bleeding cash through depreciation.
Right. And you might ask, why wouldn't a hardware provider just vertically integrate and take the depreciation hit if it means capturing the entire fare?
Because the unit economics of idle capital in a low-margin transit business will destroy their balance sheet.
Uber's hybrid network solves the utilization problem. They utilize AV partnerships to handle the predictable, low-volatility base load of daily transit. When demand spikes due to weekend volume, weather events, or local surges, Uber dynamically routes that excess demand to its flexible network of human drivers.
It pushes the peak volatility and asset depreciation risk onto the human contractor while optimizing the utilization rate of the autonomous fleet. And the operational data backs this up. In Austin and Atlanta, where Uber has integrated AVs alongside human drivers, the hybrid network is delivering 30% higher vehicle utilization than pure AV operators in isolated markets.
They are routing twice the trips per vehicle per day compared to autonomous fleets operating independently in Los Angeles. It demonstrates that AV manufacturers require Uber's demand density and algorithmic routing efficiency just as much as Uber requires their autonomous hardware.
That symbiotic dynamic explains why industry leaders like Waymo are establishing routing partnerships with Uber, rather than attempting to build a competing, vertically integrated consumer application from scratch.
Exactly.
But expanding our view even further, bringing in some of the wilder news from the sources. Uber's infrastructure ambitions extend significantly beyond ground transport. They have a strategic partnership with Joby Aviation to launch Uber Air taxis in Dubai.
It sounds like science fiction, but the integration allows users to book an electric vertical takeoff and landing aircraft in eVTOL directly through the existing Uber interface.
While eVTOL integration feels speculative, it is a necessary countermeasure against emerging transit technologies. I mean, we also reviewed the operational data for the Boring Company's Vegas Loop. That's a subterranean tunnel network currently moving 20,000 passengers an hour at approximately 50% of the cost of an equivalent Uber ride.
When subterranean transit is moving volume at half the unit cost, it presents a tangible threat to ground-based mobility margins in dense corridors.
So how does Uber structurally defend against fixed route, high-volume alternative transit?
By establishing themselves as a universal routing and payment layer, the Joby Aviation Partnership reveals their terminal strategy. Uber does not want to be defined by the vehicle.
Right.
Whether a user is routed via a human-driven vehicle in a sprawling suburb, an autonomous robotaxi in an urban core, or an electric air taxi circumventing ground traffic, Uber's objective is to process the transaction, control the algorithmic routing, and own the consumer relationship. They are building a multimodal transit API.
So what does this all mean for you and your portfolio allocation? We've unpacked the cash flow quality, the regulatory margin compression, the NOL tax shields, and this massive hybrid AV strategy. The Wall Street consensus remains remarkably uniform in its optimism.
Very bullish.
Out of 34 analysts actively covering the stock, the aggregate rating is a definitive buy. The breakdown shows 47% rating it's a strong buy, 44% maintaining a buy rating, and 0 analysts recommending a sell.
With a consensus price target sitting at $106.76.
Based on today's trading price of $73.84, institutional models are pricing in at almost 45% upside.
The institutional models are heavily weighting that $20 billion buyback, the high-margin advertising growth, and the structural advantage of the hybrid AV network. However, prudent capital allocation requires balancing that aggressive upside against the specific vulnerabilities we've analyzed today. The technical indicators are currently flashing a 0 momentum rating, suggesting near-term downside volatility. The UK regulatory adjustments are establishing a legislative precedent that threatens to structurally compress mobility margins globally. And fundamentally, you have to discount the valuation multiple to account for that $2.66 billion insurance reserve float inflating the operating cash flow.
It requires a rigorous evaluation of the adjusted metrics, not just the GAAP headlines. And that leads to a final strategic consideration I want to leave you with today. We've analyzed Uber's transition from a scrappy, unprofitable software app into a cash flow positive logistics network. But consider the terminal phase of this transition.
The multimodal API phase.
Exactly. If this company successfully navigates the regulatory friction and evolves into the primary decentralized routing engine for autonomous hardware, delivery drones, and aerial transit, at what point do we stop calling a rideshare company and start realizing it might just be the operating system for the physical world?
And if a single private entity controls the routing algorithms for the physical world, who exactly holds the power in that world?
Something to factor into your risk models as you monitor the trading channel this week. Thank you for joining us on this deep dive. Keep questioning the numbers, look beneath the surface, and we'll see you next time.